thanks for joining me on my market report. My name is Mike, and this market report, if you haven't watched my videos, is on mortgage rates. We kind of get into what's impacting mortgage rates on a daily basis, whether it's economic data that's being released, or if it's a different sentiment in the markets, or headline news, or geopolitical, different things that could, different variables that could go into impacting mortgage rates. And sometimes you would think the logical always makes sense, but sometimes it goes against the grain, and there is no logic behind it. So we kind of try to get into um, that information and provide that for you. So this is a great resource for those who are in the market to refinance or purchase. So that way, if you're following rates, hopefully you will get some back end information to help you decide if you'd rather to lock in your rate or to go ahead and hold off and see if the rates get better. So a little bit about myself. I am a loan officer. I do work with the National Lender. We're here to help you out. We love to earn your business, as we do carry a lot of different great loan programs. We do offer great rates and service. So we do loans in all 50 states. So we're here to help out. If we can uh, help you out with the refinance or purchase, please reach out. But we're also here to help you out if you got questions. We can answer questions regards to the mortgage loan process, if there's what kind of programs are available out there, if you're looking at even about these mortgage rates, these videos, please feel free to reach out. We'd love to be able to talk with you guys. Without further ado, why don't we begin with our mortgage our market report here. We'll start off with the economic calendar. We got a few items here on the jobless claims that we get every Thursday. So last week, the initially came out 332,000. However, that got revised slightly higher to 335,000. Forecasts were calling for a dip down to 320,000. Instead of a dip, it went upwards to 351,000. So it jumped up 16,000 people. Now, here's something we don't always report on, but we like to kind of keep our eyes on. As you can see here, the continued claims jumped up. So last week it was at 2.665 million, and it was revised higher to 2.714, and it was actually forecasting to go lower, because we have been seeing it lower. Uh, in this case, it actually went higher. It went up to 2.845. So this is something we'll have to kind of keep our eyes on as people stay on employment versus getting off. Now we also got market PMI coming in, IHS market PMI for both services and manufacturing. So anything above 50 on these indexes are considered an optimism or expansion. So this is for the services industry. So the last reporting back in August, it was at 55.1. Forecast was supposed to be a slight dip to 55, yeah, and it dipped a little bit further down to 54.4. Now on the manufacturing side, it was a little bit higher. It was at 61.1 back in August, and forecast called for go a little bit higher to 61.5. And instead of going higher, it dipped a little bit further down to 60.5 for the month of September here. Now, last but not least, we got the leading index, economic leading index here for the month of August. So in July, it was actually revised from zero point 0.9 down to 0.8%, and these are month over month. Forecast was supposed to be a little bit smaller month over month for the month of August. It was at 0.7. However, it exceeded that at 0.9%. So this was a little bit better. So a mixed bag of news. Continued claims was not so good, especially if we look at the continued claims. Market, market services and manufacturing have dipped a little bit further. So something we want to keep watching. And then, of course, but on the good bright side, we got economic leading indicators showing that some pretty good numbers right there as well. We'll have to wait and see how September looks, but this is kind of gives us our medium term, usually up to about 6 months of what the economy might look like. So growth wise, so I have some promise right there. Stocks are up today. They are looking at yesterday's the Fed meeting. They're looking at that. There's really no surprises on there. The Fed basically stated that they would look into look at the data, but they're looking into possibly tapering again this year. Tapering this year, so they kind of held steady on that. They didn't really try to come out too hawkish or too dovish. They just tried to come out with what's meet the expectations. However, one thing that caveat that did come out was that they are talking about maybe on the dot plot that they could potentially even raise rates next year. So that is a possibility, depending how the uh, depending how the if they hit the numbers that they're looking for. Obviously jobs is a big priority, and they want to see if they can get that going. And then of course we want to make sure inflation's not getting out of control here as well. So stocks are liking that. They're believing that the higher risk assets are taking center stage to get more rate of return on the money. So they're taking money out of the bond market, which you're seeing here, as bonds are taking quite the beating today. It was down much lower, and as you saw probably earlier, these are getting repriced, which means for the worse. So a lot of lenders are pricing in worse pricing today. So mortgage rates are up today from yesterday's, as we're currently down about 31 basis points. But as you see here with this wick, we were even down much further here. And same thing with Treasury. Treasury touched the 10-day or 100-day moving average, has subsided a little bit, but we were at 1.4, which is a range we haven't really seen in a while. So this is something we'll have to kind of keep our eyes on, but hopefully it will still subside a little bit. But it's a possibility that we could see this pullback. We could see this a little bit more. Before we were about the 138 range, but now today we're even going a little bit higher. So it's definitely pushing its extent, pushing itself on it a little bit higher. So they are expecting, some investors are expecting maybe 2% on the Treasury by end of the year. So be prepared for a big jump in rates as a result of that. So, all right, folks, that's about it. Mortgage rates, unfortunately, did worsen a bit today as a result, even though the stock market is doing well. Money's flowing from one to the other side. And if you guys, again, got questions, please reach out. We're here to help you guys out. If you guys like these videos, we greatly appreciate it. If you can just go ahead and smash that like button. It certainly helps us out. And thank you so much for watching. We do appreciate you guys. I hope you guys have a great rest of your day. And something I did forget to touch on, I'm sorry. If you look down here, the 30-year did go up slightly to 3.01% on the national average, and 15-year go up to 2.45. So thank you for watching. Sorry about that, but wanted to kind of get that out to you guys. You guys have a great rest of your day. See you guys tomorrow, and bye-bye.